Today we're going to talk about the FIRECalc online retirement planning tool. We're going to talk about the pros and the cons. I've been a financial advisor for over 25 years. I've built hundreds of retirement plans, and it is that empirical data set that I rely upon for the opinions that I'm about to share with you. So let's start with the pros. Simplicity is a big positive for the FIRECalc online planning tool. There aren't a lot of variables with this tool. You just enter a few numbers and you get results. Very easy to use from that perspective. The FIRECalc tool is accurate and it allows you to investigate a range of possible scenarios. The FIRECalc tool uses historical data all the way back to 1871. I really love this feature of the tool. What this allows you to do is to see the impact of both bad timing and sequence of returns risk. For example, if you put into the tool that you would like to retire for a 30-year period, the output will incorporate 124 30-year periods, and you will see various paths. It's similar to a Monte Carlo simulation, but it's not forecasting. Instead, it's backwards looking. We're using all of the historical data. And what's great about that is you will have a few paths that incorporate some really, really bad times. The Great Depression, the dot-com bubble of 2000, the 1970s, et cetera, et cetera. So it gives you a very realistic feel for what to expect under adverse conditions and great conditions. You'll see the lines going way up are going to be your best case scenarios. If you invested at the bottom in 2009, for example, at that point, everything's going to work. I have some videos on the 4% spending rule with 25-year illustrations that can give you an up-close look at what happens when you have bad timing and sequence of returns risk. This is more clarity than what you will see with the FIRECalc tool. When the FIRECalc tool runs your calculation, those paths that are on the lower end of the output, those are going to be the years where someone invested for a 30-year period, for example, at the height of a bubble like 1929 or 2000. So while the tool is great at showing all of these potential paths, it doesn't delineate which path is bad timing, retiring in 1929 or 2000 or something like that. The FIRECalc tool allows you to adjust the inputs so that you can see what level of spending on your portfolio equates to a very high percentage of success. And by playing with these inputs, you can teach yourself what is a safe withdrawal amount relative to your assets. It's a great feature. The FIRECalc tool allows you to inflate your income stream throughout your retirement, and I think we'd all agree, after the last few years, having some inflation protection on your income stream is a good thing to do. Because of its simplicity, the FIRECalc tool allows you to zero in on the big picture right away. Now let's talk about 3 ways that you can get yourself into trouble if you're using the FIRECalc tool as your sole means of retirement planning. Number 1, the FIRECalc tool has a baseline assumption that you will use a static 75-25 equity to fixed income asset allocation throughout your retirement. Now, I think this is fine. There's nothing wrong with that asset allocation, and the numbers show that it's going to work. But for most retirees, it's far more volatility than they can handle emotionally, right? That is where things fall apart. Many retirees cannot stomach a 50% loss. And if you're using a 75-25 asset allocation, you have to be prepared for the possibility that you could see half of your portfolio erased, temporarily maybe, in a severe downturn, like we had in 2000 to 2003 or 2007, 2009 time periods, where the market went down substantially. If you're running a 75-25 asset allocation, you could lose a lot of money in a few years, especially if it's a sequence of negative years. Sequence of returns risk can really cause problems. Now, you might be fine in the long run, but what I've experienced is that many retirees will panic once they see their portfolio down 30% or more. it becomes very, very troubling on them. The tool does allow you to change your asset allocation. You can move it down from 75-25 to 60-40 or 50-50, for example. But what the tool doesn't know is your emotional appetite for risk and how you're going to react when we get a recession. And it's not if, it's when. Historically, we get a recession about every 7 years. We're long overdue. Here's what a recession looks like up close. We're looking at the period of March of 2000 to April 2013 for the S&P 500. 13 years, no appreciation. Two very serious drops along the way for the recessions of 2001 and 2008. Most people, most retirees simply cannot handle this level of volatility. The FIRECalc tool baseline assumption is that you are 75-25 equity to fixed and that you will be static the whole time and rebalance your portfolio to 75-25 along the way. In my experience, most retirees just can't handle that type of volatility. When you get down this much, a lot of retirees get really nervous. They start to panic when they see their retirement portfolio dropping by 30% or more. With a 75-25 asset allocation, the baseline for the FIRECalc tool, you might not be down quite this much in a recession, but you're going to be close. And if we have several negative years, sequence of returns risk, you could see significant losses in the 75-25 asset allocation baseline that the FIRECalc tool uses. Far more volatility than most retirees can tolerate. So when using the FIRECalc tool, it is critical that you have an appreciation for the potential for volatility with different asset allocations. The 75-25 or the 60-40 can exhibit a lot of volatility during recessionary periods. They're both going to work. They're going to give you high odds of success. If you use 75-25 or 60-40, they're both asset allocations that can work really well, especially when paired with the 4% rule, for example. But how do you feel? Are you going to panic if you see your portfolio dropping by 30% or more, which is possible under both of those asset allocations? And that's what's important, because you can throw your plan out the window if you sell at the bottom of a bear market. I've seen it happen more times than I can count. It's unfortunate. Doctors, lawyers, engineers, people in private equity, CFOs of companies, you name it. 2002, 2008. I've met so many people, smart people, who panicked when the market was down and sold out. So if you pick an asset allocation that is not perfectly aligned with your financial plan and, more importantly, your tolerance for risk, there is a high likelihood that when the next recession comes and the chips are down, you might panic and you might sell out. I know it sounds like, oh, that's not going to happen. But believe me, when you're retired and you're 65, 70, 75 years old, and you watch your life savings start to dwindle, it feels a whole lot different then than it does when you're in your late 40s. Your tolerance for risk just isn't the same. Very few people will stay in their portfolio when they see it dropping and dropping and dropping when they're 65 or 70 years old. It's very tough. The FIRECalc tool assumes that you stay invested no matter what. You never get out of the market, which I'm a big believer in, by the way. I think that staying invested for the long term is the way to go. But that being the case, it's critical that you have an asset allocation that you will stick with when the volatility arrives. If you look at this chart, you can see a very easy to identify pattern in the stock market. Bull markets, the green arrows eventually end and turn into red arrows, the bear markets. Then the cycle repeats. In late 2024, here we are in the late stage bull market. We're probably only a few years away from the market cycle reversing. And what that means is that it's very likely that you're going to see a bear market or several during your retirement, and therefore crucial that you do not have an asset allocation that you're going to abandon when the inevitable volatility arrives. If you have questions about your asset allocation and your spending strategy, please give my office a call. We would be happy to give you a second opinion on your retirement plan. The second way you can get in trouble with the FIRECalc tool is unplanned large expenses in your retirement. Now, the tool has a way for you to input large outflows, but in my experience, many retirees underestimate the likelihood that they will have a significant unplanned expense at some point during their retirement. So it's important to remember that costs are only going up because of inflation and accidents happen. Let me show you a list of common expenses that I've seen many retirees encounter, and oftentimes they were caught off guard. They didn't think these expenses would happen. So it's important when using the FIRECalc tool that you do account for large unplanned expenses. Here's a list of 20 one-time common expenses that can happen during just about anybody's retirement. Chances are at least a few of them will happen to just about everybody. Some of these you can plan for, like a bathroom remodel or a kitchen remodel, but others, like help with the kids, that evolves over time. You might not be planning large expenditures to help your kids or your grandkids when you retire, but things change. Families change. What about HOA assessment? I've seen six-figure HOA assessments multiple times catch retirees off guard. They live in a building and then suddenly the roof needs to be repaired or there's some structural issue and it's a big expense for everybody in the building. What about hail, wind, hurricane, flood damage? I've seen this a number of times. We have clients in Florida, for example. Their insurance company is repairing the roof, but the insurance company is not picking up other damage to the house that needs to be repaired. So these problems can show up and it can happen at any time. You want flexibility in your financial plan. And so when using the FIRECalc tool, be sure to be conservative and overestimate the likelihood that you will have large unplanned expenses in your retirement. The third area where you can get into trouble with the FIRECalc tool is taxes. Now, the tool intentionally ignores taxes, and I think that's good for a simplistic output because everybody has a different tax situation. But what that means is that you need to be an expert at budgeting. You need to know what your net cash flow needs are. The tool shows you gross cash flow. You need to solve for net cash flow. And if you are like many people who have very large tax-deferred accounts, 401ks and IRAs, you have some potential issues. Every dollar coming out of those accounts is going to be taxed as ordinary income. And if you need a large unplanned distribution in your retirement, you're going to have much more in tax to pay, potentially. You could move up into higher tax brackets depending upon your unique situation. So, because the tool ignores the impact of taxes, it's very important that you are great with budgeting and you are looking at the after-tax numbers for everything that you're doing. So let's add it all up. The FIRECalc tool is simple, reliable, and has great historical data. The tool allows you to quickly zero in on the big picture for your retirement and get a feel for what's going to be successful and what's not. At the same time, you can get into trouble with the FIRECalc tool because the tool assumes that you're an expert in asset allocation, you understand volatility, you're going to stay invested no matter what, you're going to rebalance your portfolio every year when you take your distribution, and that you are excellent with planning for your future when it comes to large unplanned expenses, for example, or that you have an excellent grasp of taxation. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.